And I think that's really important to underline. And we're going to talk about that in Pro Picks next. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, time now for a look at Pro Picks. This is Brent Joyce's we're doing it a little bit different. We're doing kind of like the assets that you would allocate to and your relative weight. And you just finished telling us, that there might be disproportionate weakness in the Canadian economy, but economy does not equal equity when it comes to the Canadian market. So your actual highest conviction equity market is the Canadian market. Is that right?
That's correct.
Tell me why.
Canada, both the economy and the market, so after saying that they're not the same thing, we have gone from public enemy number one on tariffs to, what is it last week? Let's just be friends, right? All I want is their friendship. And so there has been a shift in that narrative. All the while, the Canadian equity market has gotten less expensive, cheap, from what was already not terribly expensive anyway. The TSX, 230 odd businesses that make up the composite index. It's hard to count. You don't have to take your shoes and socks off to count the number of businesses who only do business in Canada. All right, you've got the old telephone companies, the grocery stores, and then it's like all the energy businesses, all the mining, all the forestry, all the auto sector, Shopify, the banks, the insurance companies, on and on and on. These are North American / global businesses. And so we're able to access these great Canadian franchises that have global footprint, and you get a 3% dividend yield while we wait to see what happens. They're not expensive. That's on a relative basis, when I think about Canada and then the US, I only get half the dividend. Yes, I think there's great companies there, but there's uncertainty. They're not as cheap. I'm not falling into the whole Europe is the new story. It's a story, but not the new story. And emerging markets certainly still have to work itself out. So when we look at those four big buckets that we look at, Canada continues to filter to the top.
So that's interesting, because I've been hearing for years now, Canada's a cheap market, the dividend yield, and only recently it seems to have mattered. I'm curious how long you've held this view, this more incrementally positive view towards Canadian equities, and what kind of runway are you looking at?
We've held this for quite some time, and the little secret that's been hidden in the whole U.S. exceptionalism is Canada's been performing very, very well. You look at the calendar year performance last year, particularly in Canadian dollars, a big chunk of that U.S. outperformance for Canadians is the currency, right? That's reversed a little bit in the last little while. And so you go back over 1 and 2 years, TSX is holding its own with the U.S. So we have liked it for all of that piece. For Canadians, you have the tax advantages on the dividends, and thankfully now the capital gains have stayed intact, right? And so it's been really the 3 years that I've been at BMO, we have had this view towards Canada. It wasn't equal. We liked both Canada and the U.S. for the longest time. And now Canada's just sort of nudged ahead a little bit in the, on a year-to-date basis as our more favored market.
One of the things you've also brought to us as kind of your high conviction areas is the bond market, because you can go anywhere. It's not just stocks, it's bonds as well. And so your view that the Fed is behind the curve, they should be cutting rates. But then I look at what's going on in the bond market and those yields are rising, and a refresher, yields go up. That means the prices are going down. Are you willing to bet that reverses and that bonds are a good investment here?
I'm willing to bet that it's not a symmetrical payoff risk reward at the moment. And so if everything works out wonderfully, and we need to have higher yields because the economy revs up and maybe we have a touch of inflation, I think the upside for yields from where we are today is limited, 25, 50 basis points. I think all central banks, ex-Japan, are still going to be cutting this year. And so that has some downward pressure on bond yields. But it's the protection that the bond market is offering us. So if we're going to have an equity overweight, within credit, I think about spending a risk budget. And so I can have riskier credit, riskier bonds than others within our fixed income exposure. The credit is the riskier piece. We've had a lot of that. And now we're favoring some of the safer bonds, which are the government side of things. And if we're wrong...
Is that relatively new?
That move to favor that? Well, we always have them
yes,
as a safety valve. Yes. It certainly is sort of since February, right? When equity markets were all the rage and hitting all-time highs. And we're thinking, there's a lot of things out here to be worrying about. Are we whistling past the graveyard here for stocks? And so where do we go? Well, we'll look at some bond exposure. But that asymmetrical payoff is, let's say it's 0.5% higher for yields in a world gets better, there's a little inflation story, right? Because yields moving higher because the world gets better, the real yield component, I can live with that, right? But we're wrong, we have the hard recession, this tariff reprieve we have this week is just another, on again, off again, and things get a little bit ugly, or maybe we've cooked a little bit in the cake already that's going to come home to roost, later in the year. Then I can see 75, 100, 125 basis points of decline in the bond market. And that's going to drive 6 and 7 and 8% returns in an ugly scenario that we're going to really want to rely on for our balanced portfolios.
There is probably no more formidable foe for anybody to go up against than bond investors if they try and get out of line. Yeah. And I'm curious how you think about that piece as you are incrementally more positive towards sovereign debt. They're known as bond vigilantes, whereas if a country tries to get too cute, as we saw in the UK in that very short tenure with the Prime Minister Liz Truss, and spend beyond their means, that bond investors will revolt and you just can't fight with them. The market is too large. It seems like we got a little hint of that in the US. Do you think that that's meaningful, a meaningful check and balance to what's going on in the US?
More than meaningful. It's the most important piece. So we've got some souring public opinion. We've got CEOs hiring lobbyists and marching in Washington, and they're getting exemptions and reprieves. We've got Congress starting, they were in recess for most of April, right? So they're coming back and having a say. A couple of hundred court cases challenging the president and the tools he's using. So all those are important feedback. The stock market's stumbling, and Trump came out himself and said, the stock market's just doing what the stock market does. And, there may be some truth to that. The U.S. government doesn't own stocks, so it's tangential feedback. The market going down. The U.S. government is in the bond market in a big, big way. We all know that. So it's not tangential feedback. This is direct and immediate feedback that they have to pay attention to. Scott Bessent, Howard Lutnick, these are Wall Street guys, so they know how the bond market works. And I would say that it was that rise in term premium, rising U.S. borrowing costs for the government of the U.S., the taxpayers, that got their attention. It's not the Liz Truss moment, right? It is and it isn't. It's the right concept. But for Liz Truss, we saw UK bond yields going up 300 and 400 basis points. All right. Here we're talking about they went up 30, 40 basis points in a short period of time.
Still a lot.
Still a lot.
Yeah.
And the right signal. What happens after the middle of April, and we saw that signal, all of a sudden we're doing deals, only criticizes the Fed every other day instead of every day, right? Court cases are moving through. Elon Musk goes back to his day job. There's a lot of things that pivot. And it wasn't because of the stock market in the first week. It was because of the bond market in the second week.
What do you think about the president overtly telling people to buy stocks, or now is a good time to buy stocks? That one day that he did it, it turned out to be boy, was he really right? And now this week he's kind of doing it again. And I wonder, as somebody who is a conservative investor who invests $50 billion, do you have to pay attention to stuff like this now?
Oh, I've paid attention to Trump since his first term, right? And so you do have to keep an eye on it. I'm not big in the rabbit hole of conspiracy theories and so on. Right?
Yeah.
I mean, there are certainly some exceptions for U.S. politicians where insider trading, like Martha Stewart goes to jail, but they don't.
Right, yeah.
And so at least you could say, well, the president told everybody. Right? He didn't just tell his buddies.
Wasn't a secret.
Right? But I don't think there's much to that. It's a coincidence.
Your third idea is almost... it's not a go ahead and do it. It's a be cautious on it. And it is don't get carried away in Europe. People can do that maybe on vacation, but don't do that in the market. And I think that's really interesting because the European markets have outperformed. And it's in a reaction to Trump, right? The reason they've outperformed is because now they're spending. All of a sudden they're spending on defense, including Germany. And so the market, especially for that, is ripping. And why shouldn't we get carried away? I think people are trying to figure out, okay, is this the end of U.S. exceptionalism, the beginning of European exceptionalism? And what's your 2 cents on that?
Comes back to my same comments. It's global exceptionalism. And so there are great companies in Europe. They were painted with an ugly brush. It's sort of similar to Canada, right? And so they were cheap. And so when I see markets move quickly like that, we have to ask ourselves the question, how much of it is a bounce because it was unloved? And so I think that's a good chunk of what we've seen in Europe. And now what structurally has actually changed? And you're absolutely right. There does seem to be an epiphany. The debt brake is gone and they're going to spend some more money and that sort of stuff. So it does increase my attraction to European equities. We would be trimming back to neutral. We've had a neutral weighting for the past 3 years. And so we were overweight Canada, overweight the US, and we were neutral in international stocks. And we got criticized a bit for that, but we are strong believers in diversification, and it's very hard to figure out when these things might move and for what reasons. This did come out of a bit of the blue this year, and so we were happy to have the European positions that we had. Active stock picking is working very well in that market, and so, but we don't. I'm not sure that it is a seismic change, and we are going to be talking about European exceptionalism, company by company for sure. But that's the one area where the tariff uncertainty is still hanging over. And there's more to pick away at there. Europe is a little bit more of a closed market. They have a little bit more of a protectionist attitude. The U.S. doesn't need as much from Europe as, say, China or Canada, despite the president saying he doesn't. And so those uncertainties haven't changed enough for me. And the market's moved. So I would be selling a bid, taking some profits.
The bottom line, when I look at all of this and what we've talked about, it sounds like, you're staying invested, but you're just a little bit more defensive these days.
Yeah. When you're in a storm and you're a captain, one of the best things to do is batten down the hatches. All right. And if you're in a big storm, like we were in early April, you drop the sails too, right? And you just let your ship get you through this. And so if your ship is a well-diversified portfolio, which is our bread and butter, then we've been hunkering down in that. The opportunities, they look super juicy right on the 7th of April, but when it's an external shock, that's not our training. When we can talk about how much leverage there is and where earnings and where we are in the business cycle, none of those are the conversations we're having today. It's this very binary environment. And so we've widened our tolerances, in terms of where things drift on a day-to-day basis, intraday basis, so that we're not triggering trades more frequently than we want to, and just standing still on a firm foundation for the time being feels like the right place to be. We're starting now to see some clarity. We're opening up some opportunities, and that would be take advantage of some of this rally in the U.S. We still like our Canadian positions. Bond yields, to the extent that they're up on any given day, offer some attraction. And so when you want to rebalance and prune the garden, if you will, which is a lot of what we do and what I do as an asset allocator, you want to do it in an environment where you're picking the timing of it and not have the timing dictated to you. And so that's the past couple of weeks where it's felt like the market's been dictating to us. And so we just say, oh, we're not going to be dictated to. We'll wait until we're ready.
Brent, thanks so much for being with us on the show.